Welcome my friends, Josh here, and today we will look at Japanese candlesticks. If we want to perform technical analysis, we need to be able to read charts. There are many different chart types out there. For example, the line chart, the bar chart, the candlestick chart, the Heikin-Nashi chart, and the Renko chart. But the candlestick chart is by far the most popular among traders. If you're interested in diving deeper in other chart types in the future, let me know in the comments and I will make sure to include it in upcoming videos. The candlesticks were introduced to the Western world by Steve Nissen in the book Japanese Candlestick Charting Techniques. Candlesticks normally consist of red and green candles lined one after another, and each candlestick gives us detailed information about the price movement within the specific time period. We as traders can use this information to determine potential buy or sell opportunities. Let us dive a bit deeper into the individual candlestick and what information it provides us with. A candlestick typically consists of a real body and its shadows, also called tails or wicks. For the bullish candlestick, which is green and means that price has been moving up, the bottom of the real body represents the opening price, and the top of the real body represents the closing price. The lower wick shows us the lowest level price has reached during the specific time period, and the upper wick shows us the highest level price has reached. This means each candlestick provides us with 4 data points: the opening price, the closing price, the highest price level, and the lowest price level. With this information, we know that during the specific time period, prices moved in the range between low and high price, opened at this specific price level right here, and closed at this specific price level. Here's one out of thousands of possible price movements this specific candlestick could represent. Keep in mind that we do not know exactly how price moved between those 4 data points. The same thing counts for the bearish candlestick, only that price is closing below the opening price level. The wicks tell us again the highest and lowest level price has reached during the specific time period. Technical analysis can be performed on any time frame, such as the 15-minute chart, the 4-hour chart, or the daily chart. Depending on the time frame, the time period represented by the candlestick changes. If we are looking at the 4-hour chart, each candlestick represents a 4-hour time interval. If we change to the 15-minute chart, each candlestick represents a 15-minute time interval. On most trading platforms, the candlestick will be green if the closing price is above the opening price, and red if the closing price is below the opening price. During a time period, prices are constantly changing, and therefore the candle can switch from green to red or vice versa, depending on the current price level. Once the time period is over and the candlestick closes, the following candlestick will most of the time open at the same price level as the close of the previous candle. Sometimes, however, those price levels do not match and we have something called a gap. Gaps are most common when the market has been closed between the 2 candles and occur when, for example, news were released over the weekend, causing buyers to jump into the market, which results in price opening significantly higher than the previous day's closing price. This can also happen the other way around, but we will leave it at that for this video. So how can we interpret candlesticks? Depending on the formed candlestick tails as well as on the position of the real body, a candle can signal a strong bullish or bearish move, a weak bullish or bearish move, or even a neutral price movement. If the closing price of the candle is at the same time the highest price level of the time period, we can generally consider it to be a strong bullish candle. The larger the distance between the highest price level and the close price level is, the less bullish we get. If a candle has longer tails on both sides, the price movement in this time period can be seen as neutral. Price pushed to new high and low levels, but ended up quite close to the opening price. Here a possible scenario of the price path behind such a neutral candlestick. Coming back to our overview, the same things count for the bearish candlesticks. If the closing price is at the same time the lowest price level of the time period, we can consider it to be a strong bearish candle. And here as well, the larger the distance between the lowest price level and the closing price level, the less bearish we get. Japanese candlesticks are also excellent for spotting possible price reversals through patterns. Candlesticks alone, however, should never be the only reason to enter a position, but they definitely should be included in the decision-making process. We can very quickly cover some popular patterns and go into more detail in other videos. My absolute favorite pattern is the bullish engulfing pattern, which also occurs quite irregular in the markets. The bullish engulfing candle consists of a bearish candle followed by a tall bullish candle that fully engulfs the previous candle. This results in the opening price of the bullish candle being below the closing price of the bearish candle, which represents a gap. The forex market, for example, does not have as much gaps as the stock market. Therefore, we could also consider those two candles without a gap as a bullish engulfing. The bullish engulfing is a bullish reversal pattern occurring at the end of a downtrend and can be seen as an indication of price reversing to the upside and a possible scenario to buy. The same things count for the bearish version, only that it would be a possible scenario to sell. Next, we will look at the morning star, which is basically just a variation of the bullish engulfing candle, only with the difference of a more or less neutral candlestick in the middle. With the morning star, the third bullish candle also does not necessarily need to close above the open of the first bearish candle. The morning star is a bullish reversal pattern and a possible scenario to buy. The opposite of the morning star is the evening star, which is a bearish reversal pattern and provides us with possible scenarios to sell. Last but not least, the hammer, which is a candlestick with a small real body, a tall lower shadow, which is at least 2 or 3 times the size of the body, and a small or no upper shadow. Price has fallen down to a price level quite far from the opening price and came back all the way up. This is an indication for bullish strength and a possible price reversal to the upside. The opposite of the hammer is the shooting star, which can provide us with great sell opportunities. As you can see, reading candlesticks is not as confusing as you might have thought in the beginning. Once you get used to it, it really isn't rocket science. And that's it for this video, my friends. A very basic and simple overview on candlesticks. If you enjoyed this video, you would make me very happy if you give it a thumbs up and subscribe to the channel. See you next time.